Good afternoon, everyone, and welcome to another episode of Investing with IBD. It's Justin Nielsen, your host, and it is September 25th, 2023. We're coming to you a little bit early this week because, as you may have noticed, Irusha doesn't have some ridiculous helmets in his background. He has gotten rid of them. He's becoming more professional. No USC or or Raiders caps. What's going on, Irusha? How you doing?
I'm doing well, Justin. I'm back in my old stomping grounds in Boston, Massachusetts here. I want to say it's a nice sunny day here, but it's Boston, so of course it's not sunny here, which is
Right.
why I moved to LA.
Yeah, exactly. So that California weather is just not something you quite get up that at that longitude, or latitude, excuse me. But of course, this is Irusha Peiris, who joins me every week. He is a portfolio manager at William O'Neill, O'Neill Global Advisors, and yeah, he's actually doing that other job of his right now. So that's one of the reasons why he's out there in Boston, chatting with clients and all of that. But he still is making some time to chat with us. So let's get right into it. We're going to talk a little bit about the market, of course, in our first segment, and then a little bit of a learning lesson. What kind of went wrong with this rally? And then we'll get into some stocks that are potentially setting up. So start us off, Arusha. I mean, the NASDAQ composite, today we undercut those August 18th lows, but seem to get support right around that 13,162 level. Of course, the S&P 500 had already pierced that August 18th low, and the Russell 2000 and the Dow Jones Industrials, of course, did that long ago. And also, since we're talking about it, we might as well bring up that the RSP, which is the equal weighted S&P 500, also had knocked out those lows a long time ago. Of course, that never got above the 50-day moving average line, and also plunged below its 200-day moving average line fairly quickly. So, with all of this attention on the lows being breached, what do you make of the market right now?
Well, we're in a corrective phase, right? It's marketing correction, so it's a risk-off type of environment. And so really what we all need to do now is just make sure that the stocks that we own, we're not down, we're not hitting those stop losses, right? You want to try to raise cash, and so you want to really, a lot of times what I'll do is and this is what I learned at O'Neill, we both learned this, but you sort by performance, your portfolio, sort the stocks by performance and see which ones are up on the most, and then you start cutting from the bottom.
Right.
And that's an easy way to raise cash. But if you've been listening to the market, I think over the last few weeks, when you went from an under pressure to a marketing correction, a lot of times the market's going to slowly push you out of some of those stocks, or maybe even quickly push you out of some of those stocks. And so you should already have generally, or at least generally, I'm in some cash before we go into a correction.
Right. Yeah, I was just going to say, for some folks, thinking about the, raising cash now is a little bit late. You don't want to be raising cash when you're breaching those lows. Usually, it's when that distribution starts piling up, and it really did start piling up pretty quickly.
Yeah.
You got, distribution after distribution. There were a lot of distribution clusters, so there was certainly reason to be cautious. Of course, distribution days, the way we define them, are days that are down more than 0.2% or more, and the volume increases from the day prior. Of course, you can also have stalling days in there where are also having higher volume, but in that case you close positive, but you just don't make much progress. And we kind of had a lot of that in this last rally attempt, where and fairly quickly too.
Yeah, now I think the undercut, like we're looking at the Nasdaq right now, I think the undercut, that's a positive, and especially since we got a little bit of an upside reversal here.
Mm-hmm.
So you want to take a step back, and so the first thing is the fact that we undercut it. That, I think that's a positive, especially if you're in cash, right? Or
Yeah,
if
right.
you're mainly in
It's
cash,
always
right?
easier
Right. Yeah.
to handle the corrective phase unemotionally when you're in cash.
Very true. But we did undercut it. We had an upside reversal. And really what this is day number one of an attempted rally. So the earliest we could get a follow through day is Thursday.
Mm-hmm.
And so now what we're doing is we're just going to observe, and we're just going to count those days and see. if the market gets a fall through day. If it undercuts today's lows, we'll just reset the count.
Yeah, yeah, it's just that simple. And for some folks who do like to try and get in early, you at least have a very clear-cut signal at that reversal low. Hey, is your thesis working? Is this a bounce? And if it doesn't, but a lot of times, again, rather than try and get so close to the absolute bottom, we give it a few days just to improve our odds. Let's talk a little bit macro. Of course, one of the things that is putting pressure on the market. I mean, have you looked at the 10-year yield lately?
I'm
That
looking at
thing,
it now.
that
Wow.
thing looks like a growth stock. I mean, it just has been skyrocketing. And on top of that, you also have the dollar. If you look at UUP, which is a ETF that tracks the U.S. dollar index, bullish fund. That's also been doing. It's been in a solid uptrend. So, of course, when you have rates, and it's really the longer yield that is going up here. I mean, today Ed Carson made the point that the 2-year and the 3-month and those shorter terms weren't really moving nearly as much as your longer yields are. Does that help us get away from the inverted yield curve? Is it a good sign? The government shutdown potential is coming this week. There's a lot to digest here. What's an investor to make of it?
Well, yeah, honestly, I feel like there's always a lot going
Yeah,
on, right?
yeah.
You're always going to find a reason to be bullish, and you're always going to find a reason to be bearish. Which is why I love the kind of the market analysis, the rules based approach that IBD uses, because in the end, it doesn't necessarily always mean the news. I mean, it's important to know what some of these big catalysts, and definitely important that to know that the 10 years breaking out that powerfully. But you always want to see the reaction. How are the stocks that you're interested? How are the markets acting towards that? Because sometimes the news can get so bad that all of a sudden it's all baked in, right? And the
Mhm.
market's always looking out ahead. So you always want to look at the reaction to the markets, and in this case, in the market's case, just follow that rules based approach to see if we get a follow through day. So we kind of put a check mark on one of those things and say, okay, we have a follow through day. Now, are there stocks breaking out? Because that one of those rules, when you have a follow through day, you must look for something to buy. But if there's nothing to buy, then you're still in cash, or you're lightly invested.
Mhm. Um, one other thing that we kind of touched on it a little bit, but maybe we could go into it a little bit more. If you look at GMIAB, one of the issues that we've kind of been complaining about for the whole year, but especially lately, is this lack of breadth. And this advanced decline line on the Nasdaq really paints pretty
It's
a pretty
amazing.
bleak
Yeah.
picture for how bad it is for most stocks. And of course, we were talking with David Keller last week, and and this is something that a lot of people pointed out. I think Miss Schneider pointed it out as well, that you've got the indexes were making highs, or near-term highs at least, but you had a lot of stocks that were, a greater and greater percentage of stocks that were below their 50-day moving average line, below their 200-day moving average lines. That number was growing. If you look at NASDQ, the general market indicators on MarketSmith, you also see that, for the most part, the new lows, this 10-year average of the new lows, has been on top of the new highs. It's really been more new lows getting made out there than new highs. So, what kind of market internals are you looking for? I mean, obviously we're going to want better breadth, but um, are, how much is enough to say that it's sustainable for most stocks to participate and allow our portfolios to do better?
Yeah, I mean, in strong bull markets, you want the market to broaden. That gives us more confidence. But that being said, we saw it just only a few months ago that these markets can go up if some of the Magnificent Seven goes up, right? They just have such an influence on the indices that they themselves can move them up. So if you are astute and those are your type of stocks, you don't necessarily need to see all of the other indicators going in the favor. Now, you ideally for those strong bull markets where you can get even more aggressive, yeah, you want to see these indicators start to increase more participation. Even like the percentage of stocks above their 30-week moving average or
Hmm.
150-day
Yeah.
moving average. For the in the New York Stock Exchange, it's only 37% are above. This is 150-day. This is not even the 50-day,
Yeah.
right? So that's a much longer term moving average. Only 37% are above it. For the Nasdaq, it's only 30%. So this is a market that has been getting narrow and it's getting even more narrow. And so yeah, it is concern. Uh, Over really to prepare for to meet with all these clients over the next few days. Yeah, I went through tons and tons of stocks this weekend, and it is shocking at how much damage there is underneath the
Hmm.
surface.
Hmm.
Now, that being said, you don't want to assume that this is going to be a prolonged, it has to be a significant correction or anything.
Right.
As we've seen already, the markets can turn pretty quickly.
Hmm.
But I was pretty surprised that all of a sudden, all those semiconductors that were acting so well for so long, they're not doing well at all. A lot of them are breaking some key support areas and are in some decent downtrends right now.
Hmm. And just one other thing here, because you kind of touched on this, how look, you don't necessarily need it to go down a lot more. Certainly, I think we've been talking about this whole seasonality. A lot of our guests have brought it up. Jeffrey Hirsch,
Yep.
kind of, the Stock Traders Almanac, he laid out the whole kind of idea of what the year could look like based on historical, weakness in August and September, bottoms that often happen in October. How much credence are you putting onto this seasonality aspect in the hopes that maybe October is where a bottom comes?
Yeah, that is still my hope.
Hmm.
It So I do put credence in it. I wish I would put more. A lot of times I just kind of forget
Hmm.
more than anything because I've always thought it's really interesting. And if you look over the last year, especially when we had Jeffrey Hirsch on, we had him last year talking about this, maybe at the beginning of the year when we talked about 2022, and then this year he nailed it. All right. He said last year that the markets should bottom in
Hmm.
October because of the third year of the presidential cycle. Uh, and now this year, it was should run into July, right?
Hmm.
Not necessarily the May. It was the Nasdaq stocks a lot of times run through the end of June, and so then they start topping in July. And he was on. We had shortly afterwards during July, where he said, "Yeah, it's probably going to struggle through September,"
Hmm.
and it's almost like clockwork. So you do want to definitely keep that in mind. Now, that being said, if you've caught some of these great stocks that have been trending well and you're doing well and you're in sync, yeah, you want to listen to stocks, right? And you want to listen to your portfolio because you might be in sync and you might be getting some of the ones that are really outperforming the market at that point. So seasonality is one part of it. So you want to make it part of the game plan and just know where you are from that perspective too.
Yeah. And as always, we like to wait for that price to confirm it, not just go, oh, well, it's October, I set my calendar, set my watch, and, have the alarm go off and it's time to buy. You really want to make sure that that is being confirmed by the price action because, look, while that might be good for the average, you don't know if that's going to be good this time around. So, okay, well, we're going to take a break real quick. And when we come back, we're going to talk a little bit about the portfolio management side of things and how you can kind of know very early on whether your rally is getting into trouble and having conviction in those big themes. Stay tuned. We'll be right back.
The stock market moves quickly. It can be a lot to keep track of. But what if you had a team of experts feeding you research and trade ideas every morning? Market DM by Investors Business Daily is a daily newsletter that boils down everything you need to know about the stock market into a 5-minute read. You get actionable trade ideas for stocks and options in your inbox every day, plus educational lessons to help you elevate your trading. Subscribe today for only $20 a year. Just go to investors.com/marketdiem, that's market DIEM, to get started.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with my special guest who actually joins me every week. But this week he is special because he's joining us from Boston. It's Irusha Peiris, O'Neill Global Advisors portfolio manager, and he's doing that other job of his, talking to clients. And we talked a little bit about how, this market has been tricky, but there were some early signs. So if we just talk a little bit more generally, when you get the market having a follow-through day, what's your typical response in knowing whether or not it's going to work? Because let's face it, they don't all work.
Well, so as I mentioned in the first segment, when you have follow-through day, you must buy something, right? You must look for something to buy, right? And so that is a key part of the follow-through day. Now, there's a reason for that, because and we saw it last year, when you go through some severe corrections, when you get a follow-through day, you don't want to buy anything on that follow-through day. You're naturally assuming that it's not going to work. Why should I throw any money at it? So you definitely want to use that rule of 100%. If you see something breaking out that you like, or something that's pulling back or getting through some kind of resistance, you want to put a little money to work, because it's very important, because having a little bit of money to work can help shift your mindset. It's very easy to become so bearish or even so bullish, right? After a few weeks of the market going up or going down, it's amazing at how quickly your mindset can change. But when you throw those little probes in, or you take one position in, and suddenly you see that the follow-through day is slowly starting to work, meaning that the position that you bought isn't stopping you out, that slowly will give you more confidence. And I think a perfect example, Justin, is the April 2020, right? April 6th,
Absolutely.
2020.
Yeah.
Where we had that, and the last thing I wanted to do. And honestly, I think we had a falter day on April 2nd, I want to say, on the S&P 500. I didn't buy anything that day. But when we got it, because that was the last thing I wanted to do, is buy this market. But when I got that April 6th one, I was like, okay, I got to buy something. So I think I just threw a little bit, a tiny, like 5% in, maybe 3% in. But after a few weeks, I started seeing, just kept slowly pulling me in. And I was probably, maybe 3-4 weeks, I was pretty maybe 80% or so, because it just kept, all of a sudden just saw another reason to have more exposure, another reason. So that you want to try to be as true to the system as possible, because if you don't, you're going to find yourself in an environment where you're going to miss out on that rally.
Right. And, one of the things that I really like about what you said is kind of that slowly, right? It's an incremental approach, and that allows you to get some feedback on your trades, and if your trades are working, then you feel a little bit more confident. Hey, I can dole some more money out because I've got some cushion on these stocks. I can either add to those positions if I started a little bit small, or I can branch out to new ones. And it quickly becomes one of those things where you have a little foot in the door, and as the door widens open, you're getting more and more of your body in there. But if you get your foot in the door and the door comes slamming on it, it's better to lose a toe than an arm, instead of, being too heavy, because, sometimes, and look, we both talked about this before, but in 2000, that was my biggest mistake. It was all of those rallies that I got into too heavy, getting back on margin. And, because margin was so much fun in 99 and 2000, the first part of 2000, I wanted to get back on margin as quickly as possible, but it was, the rallies were short-lived. I was getting way too deep, way too quick, and I got my head handed to me. And so all of my, flexing that I was able to do for getting out at the top pretty well, it got decimated. I lost over half my portfolio. Luckily, I was small at the time, but half my portfolio was gone by the time the market finally bottomed in, well, October of 2002. There's that October number again. So yeah, I do think that you really have to make sure that you're getting that traction before you dole more money out. But what about those cases where you don't get the traction, where you know things just aren't working? What do you do?
2022, I think, was a perfect example of that. I want to say we had what, 7 failed fall through days
Right,
in
right, yeah.
2022, right? I think the average bear market has like around 7 failed fall through days, and so what do? You just keep getting you take small hits
Hmm.
there, and I was even in those fall through days, I'd try to buy something, and it was like a 1 to 2% position, and then
Hmm.
I just got stopped out of it. And then even then, I feel like I was still a little too slow during this last rally. I was in, but I didn't. I still doubted it, right? Because that's you're fighting human psychology, you're fighting human nature at that point where you get conditioned to and very quickly too, but especially after all of 2022, where it was just so brutal. It's psychology, and mentally, it's hard to imagine that the markets can ever go up again when
Hmm.
all you see is just stocks not working for that time period. And so that, but we had to follow today. There were things to buy, and as we saw in this last rally here, it ramped up pretty quickly, and all of a sudden there are a lot of things to buy, right? And so,
Hmm.
but you had to be those windows. They open up pretty quick and they close pretty quick. So you have to be pretty quick to get into them at proper buy points, or you're going to miss out on these little on I guess what was a 2 3 month rally right here. You're going to miss out on it, right? And by
Hmm.
the time you get into it, that's when the markets are now going. Hopefully, this is just a normal kind of corrective phase, right? Hopefully,
Hmm.
we're still in a longer uptrend here, but yeah, you have to stay true to the system. And I'm talking from experience because I've done this myself. I mean, you just have to listen to the market when it's time to go. When you get those signals, it doesn't matter what happened before. It doesn't
Hmm.
matter how much money. Justin, the market didn't care that you lost half your portfolio in
Right.
2000, right?
Yeah.
You have to follow the rules, and you have to follow the system, and slowly, incrementally move. And so I think that's the biggest thing. You don't want to go too heavy. And one of the things for me, Justin, was, and this took years. I mean, it's ridiculous now, but 20 plus years ago, we didn't have a lot of this kind of knowledge coming out so easily. But
Hmm.
I was the incremental didn't even make sense to me at that point. It's like if I want to buy stock, bought the whole position
Right.
at that
Hmm.
time. If I wanted to sell, I sold the whole position. And what happened is a lot of times I was missing out on a lot of it, and I was selling right at the bottom, and then I was mortified when the stocks would go up without me again, and it was hard to get back into them. And so that's where that incremental comes in, because it helps you manage those ebbs and flows of the markets, of the stocks, and it makes it more possible for you to manage what can be some very, very volatile stocks.
Hmm. And there's also that element, and you touched on it already to a certain degree, because again, COVID, there's no way that with as much uncertainty that was still going on August 6th, that it was like a slam dunk. Oh yeah, this is exactly the right time to buy. And
On April 6th, right? April
April
6th.
6th, excuse me. Yeah. April 6th. And, I remember, when I first started at IBD, one of the first things I experienced was the fall of 1998, when long-term capital management blew up. You had currencies, going under, and it was like, oh, this is bad. And you had just had like the irrational exuberance speech not too long before that. So it was like, oh, this may never come back. Of course it did. In October, there was a follow-through day. You had uh, the 2002, bottom shortly, it really didn't gain traction until 2003, March 2003, that follow through day. Of course, at the time, were people thinking, oh, this is a great time to invest? No, they were thinking, hey, we're about to go to war. There's a madman Saddam Hussein that's going to blow up the oil fields in Iraq, and that's going to be a big issue. Weapons of mass destruction, all this uncertainty. But as you said, not only was there a follow through day in all of these cases, but there was also stuff to buy. And I guess sometimes one of the things that's kept me out of some trouble is those follow through days that happen, and it just seems like there's nothing to buy. There's just no merchandise.
Yeah, and that's the key, right? It is on the 2003 falter day, because I clearly remember that one. And it was March 17th of 2003. It happened on the exact day when we went into Iraq. So the last thing anyone wants to do is buy stocks at that point. But on that day, when we had the falter day, you had Amazon breaking out, Yahoo was breaking out, a young company named Netflix was breaking out. And so it was just like the book. And IBD, I remember IBD nailed it at that point because I was reading it every day. And the number one group was internet content with all those stocks in it. And they were all breaking out just like Bill spoke about in the book. It was unbelievable. But yeah, so sometimes those are the ones where they're pretty obvious. There's so many things. You're the kid in the candy store. There's so many things to buy. There are others that are going to be, most of them are going to be a little bit more subtle, where they're going to be few. In fact, there are going to be some stocks that are going to break out before
Yeah.
the fall today, right? And now, if this is more of a pullback than kind of your classic big correction bear market, and then you get a fall today, if this is kind of more of a pullback, you might have just some of these stocks that have been doing well. They just might be pulling back to the 50-day moving averages and bouncing off them, or some of those energy stocks are doing well, right? So it doesn't necessarily always have to be kind of the classic one that we saw in 2003. It just might be more of the pullback type of market where they're just kind of pulling back in a larger uptrend.
And we're talking about some pretty big extremes in some of these cases. I mean, 2003, that was after a 79% correction in the Nasdaq. If you could imagine that. And the financial crisis, in 2008, that saw 57% corrections. Both of which, by the way, I was told were once in a lifetime events, and they were happening almost like it felt like back to back, right?
Right.
So, there's always that kind of saying about the harder they fall, the bigger the bounce. So do you ever look at kind of the oversold or how far down it comes to kind of give you a little bit more conviction that that's coming? Or do you look at those moving average lines? I mean, you mentioned 2022. We were below the 200-day moving average line for most of that year. Do any of those things come into play in terms of, oh, I'm going to put a little bit more credence into this follow through day because of how we're set up from the top, and how much we came down, where we are at in the relation to the moving averages, any of that?
I think the sentiment indicators that in the past that I've paid more attention to, put call ratio, that the which was in IBD, it was every day back in the day, but when you saw that spike above, right, when the markets were selling off a lot, when you saw a lot of fear come into the market, and the put call ratio would spike, that that would I'd kind of use that as a contrarian, because I was just as fearful of everyone else, right? I was the first one out the door. So using that as a contrarian indicator, but the one, and this is on investors.com, in the psychological indicators section, the bulls bears, that one where that indicator only crosses over maybe once every year, maybe once every couple of years, right? So it's pretty rare. I think it crossed over a couple times in 2022, but those are, I'll use that just more to try to manage my own fear, where it's like, okay, you are getting some extreme kind of levels here. Maybe it's time to try to, take these falter days even more seriously, and look for something to buy. So I think they are important, having some kind of oscillator, things like that. as long as you keep it in perspective, and it's part of a whole kind of analysis process, right? If you're just going to just use one of those and just go 100% in based on an indicator, that's probably a little risky at that time, because oversold can become even more oversold, as a lot of people in 2022 saw.
So one of the things that for folks that don't know, on investors.com, you mentioned how there are those psychological market indicators. What you can do is you can go to market trend, and under market trend on investors.com, you have the psychological indicators, and that includes, we were talking about the highs and lows. How many new highs and new lows are there? There's the VIX, taking a look at the CBOE market volatility for the S&P 500, the put call ratio that you mentioned, bulls versus bears, and then something that can kind of help with tops sometimes is the margin debt. When the margin debt gets a little bit crazy on the high side compared to where it was a year ago, we always do that comparison. Where was it compared to a year ago? Because the margin debt, in absolute terms, in dollars, it can get much larger just by, hey, look, there's a lot more money in the market now than compared to 1980. So those are a few things that you can take a look at to really kind of get that sentiment down. One more thing to just kind of talk about, and you and I were chatting ahead of the show. There is kind of this theme that everyone was really getting excited about. Certainly in the 90s, it was about the internet and networking and the things that were coming. In the aughts, you had digital cameras, the phones, getting much more sophisticated in what they could do, and we've had cybersecurity themes, and of course, AI has been one of the themes that a lot of people have been talking about this year. It's something that really kind of captures the imagination, but here again, there's a timing issue, right? So what is it that you look for in terms of, you think that you've got a theme that can really make a big difference, but how do you know it's the right time for that theme to come to fruition?
You know it's the right time by looking at the behavior of the stocks on the charts, right? And so it really just comes down to the basics of what we're using, the rules that we're following to get into any stock, and also the rules you follow to get out of stocks. And so I think even like Nvidia, right? And I still own some shares of Nvidia. Uh, Nvidia formed, and I'm looking at a weekly chart here on Market Summit. It formed a cup with handle, and it broke out of it around 197, 187. And that was early January, right? Remember when everyone's convinced that the recession was bound to happen very soon, and there's no way the market exactly, and there's no way the markets could go up this year. And here was Nvidia breaking out of a cup, showing tremendous relative strength, and then showing a lot of tight weeks. And then, of course, as we know, a few months later, had that big gap up. And also AI, everyone's talking about AI because they were selling tons of their chips because everyone needed to have the H100. Is it the H100? That chip, right? So, I think NVIDIA is a perfect example of how, if you're following the rules, we had a fall through day. We had a fall through day on January 6th of this year. Then you start, and you're looking for stocks that are holding up the best, or showing some good relative strength. And so here's NVIDIA is one of them, forming a base, and then it broke out powerfully. And after that, it acted perfectly, where it just slowly crawled up. Right? It made it very difficult to get into it if you didn't buy it out at that base, because it didn't really form another base. I mean, you could argue that it formed a flat base around 260. But it's not captured on pattern recognition here, and the best stocks are never going to make it easy for you to get into. So that's definitely one to study.
Yeah, and as you said, again, the price is kind of one of the things that we really pay so much attention to, because even with stocks, you can get really taken in. I mean, I can't tell you how many times I've read a New America story, and I've been like, this has to go up. This is just such a great idea. Yeah. And then you look at it, and there's just no appetite for the stock.
Yeah, and just very quickly, because we were Mike and I, and Mike's the producer of the show, but we were talking about this before the show started. Just because like AI, right? We have a pretty good idea, or it's a pretty good bet that AI is going to change everyone's lives eventually, right? And it already is for a lot of people. But it's remember back when the internet came out in the 90s, and then throughout 2000, we had the big .com boom, .com bust. Then you went through a number of years where these eventually great internet stocks were just forming big bases and things like
Mhm.
that, and a lot of others went out of business. And so eventually, yeah, we were right. We all knew back then that the internet was probably going to change all of our lives, but it took time for them to be reflected in stocks, and it took it wasn't always very consistent. So same thing. If you keep it very simple to that price and volume action and following those rules, that will help you be there when the markets are ready to reward those themes.
Yeah. And we've seen this, time and time again. Back then it seemed like everyone was just putting .com on their name. Oh, we're pets.com, we're
Yeah.
this.com,
Yep.
we're everything.com. And there was no business plan. You had that to a degree where for a while there it seemed like everyone was just sneaking blockchain or crypto into their
Or now
and
AI during the
and
conference
now
calls,
now
right?
it's AI. So,
Yeah.
again, just because it's a blockchain company or a AI company doesn't mean it's going to be one of the ones that lasts. We saw so many companies that came out, but it was the Netflix, it was the Amazon, it was just a select few that really ended up changing things for us. So I think that's a good place to stop right here. We'll take a break, and when we come back, we're going to talk about some of the stocks that are holding up a little bit better. Stay tuned. We'll be right back.
The stock market moves quickly. It can be a lot to keep track of. But what if you had a team of experts feeding you research and trade ideas every morning? Market DM by Investors Business Daily is a daily newsletter that boils down everything you need to know about the stock market into a 5-minute read. You get actionable trade ideas for stocks and options in your inbox every day, plus educational lessons to help you elevate your trading. Subscribe today for only $20 a year. Just go to investors.com/marketdm, that's market DIEM, to get started.
Welcome back to Investing with IBD podcast. It's Justin Nielsen here, along with Irusha Peiris, who is joining us from his hotel room in Boston while he's doing some work out there, chatting with clients. Let's talk a little bit about stocks. It seems counterintuitive, when you've got a market where you might not be wanting to do any investing. We're talking about raising cash, but yet we are always talking about what kind of stocks do we want to be looking at? How do we build our watch list? And it's really all about being ready for buying when that time comes.
One of the things that I especially learned in house is you never want to drift too far away from the market. So a lot of times when I started out, when I used to live in Boston and read IBD and was learning this system, when we went into correction, I was like, oh great, I have like 2 months off.
Mm-hmm.
Market's going to correction. It'll probably take a while for these stocks to base out. I don't have to do anything.
Yeah.
And you want to do actually even more work during the correction, because a lot of times the best stocks are going to come back only during a correction and form new bases. So you want to be aware of it. But the other thing you want to do is pay attention to what stocks are holding up the best, because you might be picking up on some rotation that's happening. And there was rotation over the last 6 weeks or so into energy stocks
Yeah.
and things like that, right? And out of tech stocks. Uh, and so you definitely want to always try to listen to the market and try to figure out, okay, what stocks are holding up the best? Where could the money be moving? Just to be aware of it. It doesn't necessarily mean you have to run out and chase everything and go to categories that you might not necessarily want to be in,
Mm-hmm.
but you want to be aware at least.
Mm-hmm. And I think we could both agree one of our favorite things to look for in markets that are in pullbacks, corrective phases, are the stocks that are holding up. And the RS line blue dot is one of those that really just helps out quite a bit, because it's just this big visual that's slapping you in the face saying, hey, look at me. And what it is, it's the relative strength line. And the relative strength line, of course, is comparing a stock versus the S&P 500. And when you get the relative strength line going to new highs at or before the stock is breaking out and going to new highs itself, that's pretty powerful. And when it's doing that while basing, or at the moment it's breaking out, that's when we'll put a blue dot on something. So you were involved with putting this blue dot in play. You want to tell any stories about it?
Well, just very quickly, Mike Webster was working on pattern recognition and with Scott Latonin, who's with IBD, and I sat next to Scott Latonin, and so Mike would sit there too, and they were did they as they and it was like a very long project. But I asked Mike one time, uh, is there any way, because I saw these bill annotations of him always circling RS line is hitting new high before the stock breaks out. RS line hitting new high before the stock breaks out. And it was just too many things to remember. So I asked him, is there any way that we can program that in that? And so that was kind of the initial kind of steps for the blue dot. And then they kind of made it even better. And they really kind of took that concept of, let's use pattern recognition. Let's use the relative strength on hitting a 50 high and put a blue dot into it. And then eventually what we did is we created a screen off of that too, which made it even easier to find these blue dots, especially during a correction. So that has really helped. And I think just going through a number of cycles and seeing those blue dots appear and things like that, it really keys you in on that rotation, and also makes you appreciate relative strength. Because in the end, we learn tons about patterns and price and volume and all that stuff. But I want to say, and over the years, I think the most important thing is relative strength out of everything. You want to know what stocks are outperforming the market, and the relative strength fund is the best way to do that.
So we've got a stock up here right now, Arch Capital Group. Not the typical area that we look at. I mean, who wants to get excited about insurance? But sometimes in a corrective phase, you have to look at what's working. I remember back in the day when you and I sat next to each other, and I first started writing for the paper. It was in the beginning of 2016, and it seemed like the IBD 50 was only full of utilities. I think there might have been some REITs in there.
That was a tough market.
You had Verizon. I think Verizon and AT&T were like in the top. So it was all these kind of like income plays. So it was just not the growth area. But let's talk about ACGL, because it's certainly, of all of these stocks that are out there that are like the market or worse, where they're below their 50-day moving average lines, getting below their 200-day moving average lines. This just looks like what correction. And even better, what I like is if you hover over the base patterns there, you can see the depths for each one. And the depth, 13% for this last one. The one before that, I think, was 14%. Oh, it was 12%. So still pretty tight. The one before that was 14%. So these are really, I mean, this is a stock that's just not giving up that much with all of these bases that it's forming. So what do you have to add to Arch Capital?
It's a stock that has been pretty consistently showing relative strength. Right now, it's showing even more relative strength as the market has pulled back. And insurance stocks, they're just working really well. Now, it doesn't necessarily mean you have to go and buy those insurance stocks, but you want to be at least aware of, okay, what within the financial sector, what are kind of the top groups, and insurance is right up there. And so I think Arch Capital is a good example of a stock that just slowly crawls higher. And in many ways, it's become a place to hide for a lot of fund managers when there's not a lot of stocks to buy. They're like, okay, let's just park some money in some insurance stocks because they should do well when the interest rates increase.
Yeah. Interest rates certainly are one of the factors here. I mean, of course, if they can get more money on the premiums that they're putting to the side, it just helps their business. But this has been something, not just the property casualty title. It's it's the brokers. It's kind of fairly widespread in the space.
And I mean, honestly, I mean, when you look at it from an O'Neill perspective here, the EPS rating 96, composite rating 99, relative strength rating of 95. I mean, these are all the kind of the ratings that we're looking for, the strong group, and even the quarterly earnings and sales here are some pretty big numbers right there. So
EPS
yeah, you
growth
don't.
rate 24%. I mean, that's not something
Yeah,
you're seeing as often right now.
yeah. So you definitely don't want to undersell and say it's all just insurance stock, just going up on interest rates. I mean, they seem to be doing a lot of things just by improving their business, and they're tapping a market that's doing really well.
Mhm. So let's just talk PEs. Normally, the PE ratio, the price to earnings ratio, is not something that we pay that much attention to. And certainly, Bill had his issues with it. The founder of Investors Business Daily, William O'Neill, used to say people focus too much on it because it keeps them from buying stocks because they say they're overvalued because the PE is too high. This is something where the PE is less than the S&P 500, and a lot of people are looking at PE a little bit closer because look, when you've got higher yields, on your bonds and everything like that, on your treasuries, and you're basically putting pressure sometimes on those higher valuation stocks. They're discounting the future earnings of those stocks, and that can be an issue. So, is PE something we should start paying attention to?
I think so, to a point. Now we still want to stick with our methodology,
Hmm.
right? But and I think it just comes back down to just being aware of the type of environment that you're in. So yeah, Justin, as you said here, a lot of these high PE stocks are getting re-rated, right? And so those multiples, yeah, the stock might be, the business might be fine. It might be doing okay on the number stuff, but all of a sudden the market is no longer going to reward that high multiple, and they're just going to crush the stock. And
Hmm.
I feel like we've seen a lot of these. I mean, Dexcom comes to mind,
Oh, yeah. Hmm.
where Dexcom, great business, but all of a sudden the big threat from Eli Lilly and Novo Nordisk with
Hmm.
the weight loss drugs, and all of a sudden now it seems like the market just might be reducing the multiples, right?
Yeah.
Where they're saying, Dexcom is a great business still. It seems like their business is still doing fine. There are plenty of people have diabetes. They're going to need Dexcom's products, but they might not need it as much because of this other variable out there. And so as a result, the market might not be willing to be paying such a high premium for those earnings anymore, right? And
Mhm.
so that in itself can cause the PEs to come down, and obviously, as we're seeing here, affect the stock. So that's what seems to be going on with a number of these medical product stocks. So yeah, you do want to be aware of, at least from now. It's very easy. If you were in Dexcom, you bought out this flat base and you got stopped out. You got stopped out.
Yeah.
Uh, and so you're protecting yourself. You're cutting your losses.
Goes back to that
But
lack
it
of traction.
exactly,
Mhm.
yeah. But it is good to be aware of it, at least saying, okay, maybe these are all just being re-rated now. The market's no longer willing to pay a high premium because of interest rates, or even because of an outside variable like the weight loss drugs.
Mhm. Let's go ahead and shift to another blue dot stock. This one is FedEx. FDX is the ticker symbol on this one. Um, we've got that blue dot right there. A nice, flat base. It seems like some of the best stocks out there are doing these flat bases. They're just not giving up that much ground. It's, just had its earnings kind of flash some, some bottoming uh, areas. Reversed off its bottom of that flat base, and saw some nice volume come in. Now, this also has a lower PE. The PE is 16, less than the S&P 500. But the earnings are a little bit more spotty here. It just had like this whole year of growth kind of, it just wasn't there. The growth wasn't there. So do you treat this a little bit differently? Is this more like a cyclical stock, like a turnaround? What are you doing with something like this?
Yeah, you're not going to you're not going to expect to get a huge gain out of it, right? The way I would look at it, if I were to try, like, say FedEx is breaking out, it's like the only stock breaking out, and we get a fall through day. So this would probably be the one that I might try, if I want to try a stock breaking out.
Hmm.
Uh, Now, getting into the stock, I'm not expecting 100%. If I get 15 to 20%, I'll be happy and I'll take the profits at
Right.
that point, right? So yeah, so I will treat it a little bit, quite a bit differently versus a stock that might be in a big secular trend, like some of the chip stocks were in, with the AI, with the whole AI thing.
Hmm. Now, there's not there's not too many stocks in this group. The transport air freight is fairly fairly small, just 5 stocks. But of course, one of the big ones is UPS, United Parcel Service. Does it bother you when you got kind of like a big competitor that's not acting right at all? And really, it seems like FedEx is very lonely in this area in terms of how it looks. Without any group move, is that something that is a concern?
Yeah, I mean, ideally, you want to stay in the top 40 groups, right? Now, I learned I the perfect example where I really learned this was uh, 20 years ago now, Apple, where
Mhm.
Apple was part of the computer group. It was a really bad industry group rating, and with FedEx, it's 149. That's really bad, and so that's another strike against FedEx because just the odds are against the stocks if it has a really poor industry group. But doesn't necessarily mean you eliminate it because it has a poor industry
Yeah.
group. It's just a negative. You want to try to find the stocks with the least amount of flaws. There are no perfect stocks out there. But with the industry group kind of negative, the Apple example always comes to mind back in 2004, 2003, breaking out the cup with handle. It was part of the computer group. So it was with Dell
Hmm.
and Hewlett Packard and stuff like that. And computer, no one was buying computers at that point because we were in a recession. Uh, but here's Apple reinventing themselves,
Yeah.
but it's still in the computer group, right? And the market hadn't caught just yet, and no one really knew at that point. But they had just come out with the iPod at that point, and they were slowly starting to change things around by going into a completely new market. So you don't want
It
to
was
necessarily
still
eliminate
called Apple Computer at that point.
it
You
was.
know,
Yes,
it was they dropped the computer when it was like, hey, wait a minute, we're no longer a computer company. We're kind of a phone company now and
right.
services, and that's where we're getting our revenue from. So yeah, uh,
Yeah, so you don't want to so you're always weighing everything and trying to find the stock with the least amount of flaws in it. But you don't want to have necessarily one showstopper from a ratings perspective. Now, obviously, from price and volume, if it's gapping down, stopping you out, all that stuff, that's your showstopper. But
mhm.
from an analysis point, when you're trying to evaluate, is this stock better than this stock? Should I buy this stock versus that stock? Uh, I don't have necessarily a showstopper, and I think actually even that time, Justin, the RS rating was only like a 50 something, right?
Yeah,
Because it was basing for so
in
long,
2004 when it came out, yeah.
which would have eliminated a lot of would have eliminated for a lot of people because that's such a low RS rating, but it had huge earnings and sales. It had strong relative strength. It had a new product, so it had enough things go, and it had a very very powerful breakout. So it had enough things going to it that if you really knew the story and maybe you had an iPod or you saw that it was really expensive, uh, you could have taken a shot at that point and been rewarded eventually. But what was kind of funny about that with the 56 RS rating or whatever it was at that point, it still took a few months for it to really get going. It was slowly kind of fighting the trend, maybe a little bit like that well, the Arch Capital. It was slowly fighting because we were in a correction. But once that market really got going, then it really started taking off, and the RS ratings started to improve dramatically.
Absolutely. Let's go ahead and just round out the discussion real quick with look at Meta, META, Meta Platforms. I mean, this is a stock that it's gone up triple. It's tripled really since its bottom,
Wow.
and uh, the fact that it's not giving up those gains is really impressive. And whereas a lot of stocks again are below their 50-day moving average lines, coming down to their 200-day lines, this has just been hugging its moving average line, that 10-week or the 50-day, depending on which one you're looking at. So this is another one where the earnings haven't been there, but look at the estimates. 2023, looking at 113%, and this is 18, over $18 a share is the estimate for the earnings. So it's not like it's going from 1 cent to 4 cents. It's these are some pretty big numbers. So do you think that Meta has another triple in it?
I don't know. I don't know about another triple, but it is showing potential. I don't know if it's even going to go up a point here, right? But it is setting up, and so you wanted to you at least want to have it on the watches and do some work on it and see if it could potentially be an addition to your portfolio. You bring up a good point here, Justin, with the negative earnings. One of the tough things about this spring rally was that a lot of the stocks that started going up, the larger cap, the Magnificent Seven stocks, they didn't have very good earnings at that point. So it would eliminate it for a lot of people who were they were looking for those big earnings and stuff like that. And so that's where it comes down to look, if you're comfortable with the price and volume, analyzing price and volume action, and you're comfortable with kind of the larger stories and things like that, you can be a little flexible. And if it's, and take a chance on one or two, maybe smaller positions, just for the risk. But now the markets are always looking ahead, and so now it's starting to get positive quarterly earnings. As you mentioned, the estimates are huge, and it's holding up well. It's gone tight over the last few weeks here, so it's essentially a 3 weeks tight pattern on the 10-week line, forming a cup with handle, relative strength line, pretty close. Now we just need a fall through day. We need a powerful breakout, and so we need. But it's definitely worth keeping an eye on, because everyone assumed that there's no way I'm going to buy Meta, especially out of that first flat base that it broke out of back in March or February when it broke out of there. There were very few people talking about it at that point.
Well, yeah, I mean, let's be honest. How many people get excited about a stock that's dropped from almost 400 down below 100? I mean, you've lost 75% of your value. I mean, that's, just to put it also in perspective, the triple here hasn't even gotten it back to new highs because it was so bad. It looked like it was like, is Meta done, for a while.
Yeah. Now it's coming up to pretty key resistance here around that 330, 340 area, right? Where that's where it really started falling apart. So it still needs to deal with that. So you do want that powerful breakout, and you want to see these kind of characteristics continue here to see if you can kind of get through some more of that resistance there. But it is one that's worth considering, right? We'll have to wait and see if it's able to go up another triple or whatever. But has a very strong prior uptrend. It's building a pretty decent cup with handle here. And it's right on the 10-week line, and the relative strength line's near. So it does have a lot of the stuff that's like, hey, let me see if there's any new catalyst for it. Does it have the powerful breakout if we get a fall through day? So it should be on that list of things to consider.
And when we're looking for strength, Meta is just it sticks out. When you have so many stocks that have fallen apart to a large degree. It's these stocks that we've been talking about. They're the ones that are holding up, and that doesn't mean that we're going to buy them. But when the market does turn, and it will eventually turn, these are the types of stocks that we're going to gravitate towards. So, hey, thanks a lot for joining us from Boston. I'm sure you're going to basically just repeat all of this stuff to the clients. They're going to be like, wait a minute, didn't I hear this on Investing with IBD? But thanks for giving us a preview. Really appreciate it, Irusha.
No, as always, Justin, it's great to be on the podcast, and it'll be even better once I'm back in sunny Los Angeles.
Sunny Los Angeles, absolutely. And hey, when you do come back, our guest next week is going to be Harold Morris. Harold Morris is one of our senior product coaches. He does a lot with option trading, so I'm sure he's going to talk to us a little bit about some of the vertical spreads that he does, both credit spreads, debit spreads, how he sets them up, how he looks at his probability of success. So for any of you option traders or stock traders that are looking to get something a little bit different to kind of help with your hedging and everything, we're going to really kind of get into options there with Harold Morris. And he's been around IBD for a long time, so he's got a lot of stuff to share. Been working with MarketSmith for a long time. So it's going to be a great conversation. Hope you join us for that. Thanks a lot for watching this week, and we'll see you next time.